In this video, guys, we're going to look at what are the most popular ETFs for day trading. Stay tuned. So you've had enough of trading Dow, you've had enough of trading S&P, you've had enough of trading FTSE, DAX, currencies, and you think, you know what? I'm going to trade the ETFs. Now, a lot of these are available as a spread bet. If you're from the UK, you've got a spread bet account. A lot of these are available in most spread betting accounts. They're available on CFD. Plus, of course, if you can trade them, you want to trade them directly in the exchange, you've got to, as a day trader anyway, you've got to be $25,000 in your account to comply with the patent day trading rule. However, loads of opportunity because the big thing about all of these ETFs is the liquidity and the spread. So we need that liquidity because if we're day trading them, we can't be paying massive spreads. There are huge amounts of ETFs out there, but a lot of them don't have a lot of volume going on. And liquidity isn't that much. So these are good because they're really thickly traded, plenty of volume, plenty of opportunity for swinging back and forth. So SPY, which is SPDR's the S&P 500 ETF, you may be familiar with that, just tracks the performance of the S&P 500. Why would you trade that instead of the futures? Well, like I say, if you're trading a spread bet, obviously that's much more feasible, but why again wouldn't you spread bet the futures? To be honest, SPY is a really tight spread. It moves in a decent way. It's a bit of a much of a muchness. You got to decide for yourself, but if you were, say, having it as part of a portfolio and a hedge, then because it trades exactly like a stock, you say, well, I'm buying £100,000 worth of SPY, you can treat it the same as if you're buying £100,000 worth of stock. So because it's an ETF and it's wrapped up as stock, it's easier to trade in that way. Okay, VTI is the large, mid, and small caps all at one. Decent ETF, that one. TLT is the 20-year bonds. You want to trade the bonds and you want to trade them through an ETF. TLT is by far the most popular one. VXX is the Volatility Index. So the VIX is the volatility component of options. So VXX is a really good way of trading volatility. It's not triple leverage, it's not double leverage, it's just a simple tracker of VIX. Of the VIX future, should I say. USO, that's crude oil ETF. So again, a good way of getting exposure to crude oil, unless you want to trade the futures directly or you want to trade a spread bet. And that's the West Texas Intermediate as opposed to the Brent, by the way. GLD is a gold, so it tracks the gold price. Again, a kind of future substitute there. QQQ, another good one. Probably should go in with the spiders and the, we'll come to Russell in a second. Nasdaq 100, so it's a great one for tracking the Nasdaq. So, you know, example, you could buy, let's say you wanted to buy the Nasdaq, but you wanted to strip Apple, Amazon, and Netflix out of it. Then an easy way of doing it would be to buy the ETF and then to take, you know, some short positions in those other three, and then have exposure to the Nasdaq 100 without those three, for example, shares in there. So that's why it's quite flexible and handy to be able to trade these as an ETF. All right, IWN is the Russell 2000, so those small caps are normally quite a volatile one, especially when things start to roll over. These are the ones that get hit the hardest. Okay, moving on to some other ones, guys. We've got XLF, which is financials, a very, very popular one, just the basket of financial stocks in there. Go and check out some of the constituents if that's interesting. So you've got FAS and FAS, which are different leveraged ETFs that are based around that. Then we've got EEM, which is the emerging markets ETF. This is growing in popularity massively now. I think it's like the fourth largest trade ETF at the time I've done this video. So pretty big. SPY is one of the bigger ones. But EEM is definitely getting there now, as actually is FXI, which is the China large cap, as more and more people want to get involved in China. Can't perhaps access it directly, can access it via proxy using this ETF, so it tracks the China large cap stocks. And then GDX is the gold miners. Now, that's an interesting one because that's really, really popular. And you think, why would gold miners be popular? I think it's popular just because it's reasonably volatile. It's quite thick, it's quite liquid, and it just moves around a lot. And you've got other little bases on that as well. You've got loads around this kind of gold and the mining sector. You've got the leverage ones, NUGT, you've got inverse ones, you've got all sorts of stuff. And don't forget, guys, you've got pretty much anything that you want you can trade. But I've just kept this to this list because we want to have, again, that tight spread, that reasonable liquidity. You don't want to be the only person in the whole thing. You want to have good, clean movements and it trading like a stock. And most of these will trade like a stock. They could easily be a high-priced, multi-billion-dollar stock and just trading with a lot of liquidity and volume like those, which is what you want. So these are an additional option. If you're into day trading, you're into catching the intraday moves, whatever they may be, you can move as and when the news flows around, whether it's from gold to oil, natural gas on here. I should have put UNG, but it's not so liquid, so it didn't make the list. Liquid natural gas, that's a good pun, that. Anyway, those are the ETFs, guys. If you're interested in those, check them out and have a look at the charts. Take care. See you next one. Bye-bye.